Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and today it's all eyes on the Federal Reserve. So we are, right now it's Wednesday, September 21st, and the Federal Reserve, Jerome Powell, will be speaking today around 2 o'clock, and so this is likely going to have some significant impact on markets, kind of determining our next movement. So we're going to get into the next few minutes, kind of where markets have been, what trends we've been seeing, but we're really now kind of, like I said, all eyes waiting to see, and markets have priced in the Federal Reserve taking a more aggressive stance, certainly in an attempt to bring inflation down. And so I would say that anything within the realm of 75 basis points or a 0.75% interest rate hike has already been priced in. Markets are expecting that. Things that could spook the market certainly would be to go above that to a 1% hike, which would be much more aggressive than what's been already priced in. I think that's fairly unlikely at this point. It's not, I guess, improbable, but most likely at this point that 75 basis point hike is what we will probably come out and see. I think though the bigger thing is that the market and investors are waiting to kind of hear what are the remarks. So, okay, 75 basis points now, but then where does that likely going to find us? Where are we going to land? And I think that if the overwhelming tone of the comments is that this is still a fluid process, that there's likely a lot more pain ahead, likely we're going to be needing to take rate hikes well into 23. I think markets could potentially sell off in the interim. I think that inflation continues to be just a huge pressure on markets, and we've talked time and again about why is inflation such a drag. Well, obviously when we have inflation, there's many reasons why this can make companies be less profitable. We talk about the fact that the cost of borrowing money is more expensive, cost of just getting goods out to your customers, it's more expensive, and as customers are feeling that pain kind of across the board, they're likely spending less because they have to cut back, because they have less money to go around all the different things, and so they buy what they have to first, and especially some of those more discretionary things can be definitely cut back. So inflation, originally the hope was it was going to be transitory. It's clear that inflation is sticky at this point, that it wasn't going to be able to just go away, and we couldn't just let it run hot. So while these interest rate hikes, they are necessary to be able to bring down these inflationary numbers back to a more normal place, it means that in the interim that there has to be these painful processes of what's necessary to be able to get to that point, and these interest rate hikes is just one of them. So again, big day today as we are all waiting to hear kind of what the next move is going to be. Again, if Federal Reserve says, hey, things are moving well. Now it's interesting, so last week, and I'm going to show you this in a chart in a second, last week markets really struggled. We had a nice kind of recovery. We had kind of recovered. If you were with me a few weeks ago, we were above all of our moving averages, and then last week we got an inflation number that came out that just barely missed the mark in terms of what was expecting. That inflation was just a teeny bit higher than what kind of we expected going in, and markets just absolutely had a complete temper tantrum over that, and so we saw sell off for days, and so markets, and particularly the Nasdaq, had some of their worst days since 2020, and so I think it goes to show though that markets are still in somewhat of a precarious space here, that they're really looking for reassurances that the economy is on firm ground. And so the other thing that markets are going to be watching here is if they think that the Federal Reserve is being too aggressive with their rate hikes. The concern is that if there's a misstep here, that we could actually put ourselves into a recession just by raising rates too aggressively. And so again, that's something that markets have to kind of price in and look at. So again, these comments are going to be really important. So it's not so much what they come out with necessarily with the rate hikes. I think 75 basis points is well within the realms of what's been priced in, what's expected. It's going to be the commentary about how long, how many more rate hikes are they expecting in the future, and we'll be able to kind of see from some of the other board members, there'll be some other of their points, what their most important priorities are coming up for the next year, and so it'll just be kind of interesting. So certainly we're going to be watching that because that will have an impact on markets today and in the short term. What I wanted to do is kind of spend some time here. We haven't done this in a little while. Wanted to talk just generally about where the broad markets are. We've had quite a few movements since we've last spoke, so just want to talk here. So Bitcoin currently year to date is down over 60%. So again, you know, I've been talking a lot with clients here about market cycles and kind of the fact that market corrections are normal parts of market cycles, and typically right before we see these, you know, longer, more severe corrective processes, we're usually coming out of a period of euphoria. And so, you know, last summer my concerns that I had and all last year about the euphoria when you could just kind of throw money anywhere in the market and you were making money, and so people were, you know, they were trading dead companies, zombie companies, AMC, GameStop. They were throwing all those meme stocks that you heard, some of the different cryptocurrencies, and it was kind of like, this is easy, you know, you can make money anywhere. I remember we said, hey, you gotta be really careful here because everybody is super euphoric at this point, and that's kind of where we are. So Bitcoin down 60%. So some of the other areas though that I just want to talk about here that I think is important, mainly, so commodities remain the only area that are positive. They're up about 18% for the year. S&P 500 right now is down about 18.7%. NASDAQ right now is down 26% year to date. After yesterday's movement, the Dow Jones is down 15%. And really interesting here is that bonds are down about 13% year to date. That has us on track for bonds to have their worst year in history. So it's really kind of been this whole barrage of tough areas to navigate, because typically bonds would be an area of safe haven for investors. And so, but in a rising interest rate market, we know that bonds are not necessarily, at least in the short term, the best place to hedge against principal risk. And so we've seen that play out this year. And so as we continue to raise interest rates, bonds will likely, and again, that's why today's discussions with the Federal Reserve are going to be really important, particularly also in the bond market. Right now, bonds they're actually, you know, when you look at the cost of bonds, they're cheap to buy right now. Just the question is, how much further could they potentially fall before we see that begin to revert again? So that's kind of where we are with the global markets. So within the S&P 500, just wanted to kind of talk here. So these were the bottoms, where we were in the bottoms June. Then we had that real nice rally that we saw all through the month of July. And then August, we kind of sold off. We tried 2 weeks ago to get above that 50-day. We did get up there for a few days, but then we lost it. So this is kind of where we're sitting right now. So bad news is that we were not able to stay above that 50-day, which means that we really couldn't use that as support. You can see here our 200-day moving average, we bounced right off that. And so again, when we talk about areas of resistance, areas of support, you can kind of see how this plays out really well. So we literally bounced off that line, came right back down. Had we gotten above that, that would have been a very bullish move for the market, that we would have likely continued to move higher. But since we weren't able to, we wound up then having a sell-off. So bad news that we were not able to hold on to that 50-day. Good news, however, we are still trading above these lows that we saw in June. So then the hope is then that this will be our new bottom. So that we did hopefully then see a bottom in June, and that if we can go ahead and reclaim it, the 50-day again, and hold that, then that would be, again, a bullish marker for the market, that we can continue to hopefully begin to move higher again. So this is within the S&P 500, and what I wanted to do here, we haven't done this in a little while, is just kind of talk about areas of the market in general, relative strength against each other. Commodities remains to be the number one area. Not surprising, because when we think of what commodities are, those are things that a lot of industries have to buy. So agriculture, energy, these areas, right? We need fertilizer because farmers need to be able to to buy these things to be able to produce their crops. Same thing with energy. We have to use energy. So commodities has been the #1 sector really just coming into this year. Domestic equities remains number 2. Now, not surprising is that the value play continues to be the strongest area. Remember, value tends to not necessarily have the highest, jaw-dropping growth all the time. Those are those companies that are kind of like timeless, that have those consistent earnings. Maybe they give dividends. So we're not going to necessarily see huge periods of growth from year to year, but these are the companies, Coca-Cola, McDonald's, CVS, that have been here a long time. They typically have good earnings and they're able to grow over time. So these are those value plays. Areas that have continued to be weak are going to be our growth areas, and that's not surprising because growth areas are impacted by things like inflation. They're negatively impacted by rising interest rates. And so these are areas that have really struggled all year, which is a big reversion from what we saw in 2020 and 21. Looking at sectors, again, energy, not surprising. We already talked about why energy is in that top area. Non-cyclical. So these are those staples that we have to buy whether we want to or not. So we have to buy we have to buy toilet paper, we have to buy paper towels, those things that we get regardless of the price. We may have to make adjustments with our budget for other things, but those non-discretionary, we have to buy. Utilities, again, that would be a value play because utilities people still need. There's certain things that they need to be able to live. Utilities is one of them. Financials and industrial. So these are all areas that continue to kind of show strength and hedges against some of those other more volatile markets like the growth space. And so finally, cash remains above fixed income or bonds. So again, just something of interest that typically we would see fixed income be rated higher in relative strength than cash. That's not the case this year. And until we see interest rates stabilize, I expect that this will likely stay the same. So again, that's just something that we've been watching. So again, just kind of in summary, all eyes today are going to be on the Federal Reserve as we wait to hear Jerome Powell's comments from the summit. And so that, I think, is really going to set the parameters for where markets could potentially go and what leadership could emerge through the end of the year. So we'll be watching to see what their thoughts are. If they think that inflation is beginning to slow to a point that they're comfortable to kind of be a little less aggressive, or if they think at this point that, again, inflation is not budging the way they thought and they need to be more hawkish, more aggressive. I think that has the potential to put some more stress, at least short term, on the markets. So we thank you so much for joining us. Again, check out our YouTube channel, some of our other channels. We did upload our first segment of summer school videos where we talked about debt and credit repair. We talked about just kind of the current mortgage rate environment and some potential strategies to help you leverage the environment that we're in. We spoke about real estate and what buyers and sellers might want to be considering. And so we're really excited. We'll be bringing the next installment in shortly where we're going to have some other local experts, but check it out. Check out our blog at victoryfiduciary.com on our website. We do write that every month. And certainly, as always, if you have any questions directly for me, you can always email me, ashleyr@victoryfiduciary.com. Thanks for joining us. Have a great day.